There is an 85-year-old man in Omaha, Nebraska, who has never once in his life bought a stock because it sounded exciting. And if you put him in a room today and asked him what he actually thinks about quantum computing, the hottest, most explosive trade of this entire year, he probably would not even mention qubits. He would ask you one simple question instead, and that single question would completely dismantle almost everything Wall Street is currently screaming about this technology. Warren Buffett has spent over 6 decades turning a struggling textile mill into one of the most successful investment vehicles in human history. And he did it almost entirely by ignoring whatever the crowd was obsessed with at any given moment. So today, we are going to walk through exactly what Buffett would actually say about the quantum computing craze currently ripping through the stock market using his own words, his own track record, and his own decades-old rulebook. And honestly, once you hear it laid out, it might completely change how you look at every single quantum stock sitting in your portfolio right now. Let's start with the obvious question everyone wants answered immediately. Does Warren Buffett actually own any quantum computing stocks? The honest answer is genuinely more interesting than a simple yes or no. Berkshire Hathaway does not own a single share of IonQ, Rigetti Computing, D-Wave Quantum, or any of the other pure play quantum companies that have dominated financial headlines this year. Buffett has never touched them. And based on everything we know about how he thinks, he almost certainly never will. But here's the twist. Berkshire does hold roughly $7.7 billion, combined across 2 companies that happen to be investing heavily in quantum computing themselves, Amazon and Alphabet, Google's parent company. Amazon Web Services runs Amazon Bracket, a cloud platform that lets researchers and businesses experiment with different quantum hardware and software. Amazon also unveiled its own quantum chip this year called Ocelot, designed specifically to cut the cost of quantum error correction by as much as 90%. Alphabet's Google Quantum AI division is widely considered one of the leading research programs on the entire planet, having already demonstrated a working prototype of something called a logical qubit, and famously solved a benchmark calculation in minutes that would have taken the world's most powerful classical supercomputer roughly 10,000 years to complete. So on paper, Warren Buffett does have exposure to quantum computing. But here's the part that actually matters, and it is the entire thesis of this video. Buffett and his investment team did not buy Amazon or Alphabet because of quantum computing. They bought Amazon because it dominates e-commerce and cloud infrastructure, 2 enormous, already profitable, already proven businesses. They bought Alphabet because, at its core, it is one of the most powerful advertising and search businesses ever built, generating enormous, predictable cash flow year after year. Quantum computing, for Buffett, is not the reason to invest. It is, at best, a distant, unproven side project riding alongside a business he already understood and trusted for completely different reasons. That distinction is not a small technicality. It is the entire foundation of how Buffett thinks about every single investment he has ever made, and it is exactly the lens he would apply if you sat him down and asked him directly what he thinks about the quantum computing hype sweeping through markets right now. So let's actually build out what Buffett would say, piece by piece, starting with the single most famous rule in his entire investing philosophy, something he has repeated in nearly every shareholder letter and annual meeting for over 50 years. Never invest in a business you cannot understand. Buffett has always talked about staying inside what he calls your circle of competence, meaning you should only invest in businesses whose fundamental economics you can genuinely explain in plain language, not businesses you simply feel excited about because of a headline or a chart going up. Now apply that rule honestly to quantum computing as it exists today. Can you explain, in plain simple language, exactly how a trapped ion quantum computer generates? And exactly which specific industries will pay real money for quantum optimization services, how much they will pay, and when? If you are being completely honest with yourself, the answer for almost everyone, including plenty of professional fund managers currently piling into these stocks, is no. Nobody fully knows yet, including the scientists building the actual hardware. Buffett has been famously blunt about this exact kind of uncertainty for decades, going all the way back to his decision to avoid nearly the entire dot-com bubble in the late 1990s, a decision that made him look old-fashioned and out of touch at the time, right up until the moment the bubble spectacularly collapsed and proved him right. He has said many times that he would rather miss out on a big opportunity he does not understand than lose money on one he pretended to understand. That single sentence alone tells you almost everything about how he would react to today's quantum computing frenzy. And here is where the story gets genuinely fascinating, because the numbers behind today's quantum computing stocks are not just speculative, they are genuinely extreme, even by bubble standards. As of the middle of this year, 3 of the biggest pure-play quantum computing companies, IonQ, Rigetti Computing, and D-Wave Quantum, We're trading at trailing 12-month price to sales ratios ranging from around 60 all the way up beyond 800. Let that number sink in for a second. A price to sales ratio of 800 means investors are paying $800 for every single dollar of revenue the company currently generates, not profit, revenue. To put that in historical context, during the absolute peak insanity of the dot-com bubble in early 2000, right before the entire market violently collapsed, even the most aggressively overvalued internet darlings rarely traded above price to sales ratios in the 30 to 50 range. eBay, one of the most extreme outliers of that entire era, peaked at around 144 times sales before crashing. Quantum computing stocks today have blown past even that historical extreme by a massive margin, and they have done it with companies that, in many cases, are still losing hundreds of millions of dollars a year with no clear timeline to profitability. Buffett has one particularly famous line that feels almost custom-built for this exact moment. Price is what you pay. Value is what you get. Wall Street right now is absolutely electric with excitement about quantum computing's price. Stocks like IonQ, Rigetti, and D-Wave have posted returns ranging from 300% to well over 1,000% over relatively short stretches this year and last. And retail. Investors, momentum traders, and social media forums are all buzzing about the next big move. But Buffett has never once in his entire career cared about where a stock's price has been. He only ever cares about what the underlying business is actually worth, based on the cash it can reliably generate, today and for decades into the future, not the cash it might theoretically generate someday if a series of extremely difficult scientific breakthroughs all happen to go exactly right. This is where Buffett's second core principle comes into play, something he calls margin of safety, a concept he borrowed directly from his own mentor, the legendary investor and economist Benjamin Graham. The idea is simple, even if applying it is not. You should only buy a stock when its price sits meaningfully below your honest, conservative estimate of what the underlying business is actually worth, so that even if your estimate turns out to be a little too optimistic, you still have a cushion protecting you from serious loss. Now think about what margin of safety even means for a company like IonQ, currently carrying a market valuation well north of $20 billion while generating under $200 million in trailing revenue and posting hundreds of millions of dollars in losses every single year. There is no reasonable, conservative way to calculate intrinsic value for a business like that using anything close to traditional valuation math. The entire valuation is built almost purely on a story about the future, a story about what quantum computing might someday become, not on anything the business is actually producing today. Buffett has spent his entire career explicitly avoiding exactly this kind of story-driven investing, no matter how compelling or technologically exciting the underlying story genuinely is. And to be completely fair here, the underlying story behind quantum computing genuinely is compelling. This is not some obviously fake or fraudulent technology. Quantum computers really could eventually transform drug discovery, material science, financial modeling, and cybersecurity in ways that sound almost like science fiction today. Boston Consulting Group has projected that quantum computing could add up to $850 billion in global economy. Legitimate, exciting number, and it is exactly the kind of number that gets splashed across headlines and fuels enormous investor enthusiasm. But notice something important buried inside that very same projection. The year 2040. Not next year, not in 5 years. An entire technological transformation still projected to unfold over roughly the next decade and a half, at minimum, and that is the optimistic case. Buffett has a specific, well-worn phrase for exactly this pattern, a phrase he has used again and again across different industries in different decades, whenever markets get excited about a genuinely transformative technology long before that technology has actually finished maturing. He calls it, confusing, a great industry with a great investment. Think about the airline industry as Buffett's own favorite historical example of exactly this trap. Air travel genuinely, unquestionably transformed the entire world over the 20th century. It is one of the most important technological revolutions in human history. And yet, as Buffett has pointed out more than once in his shareholder letters, if you had somehow been able to invest in literally every single airline that ever existed since the Wright brothers' first flight and simply held every one of them forever, you would have lost money overall because so many of those early airlines eventually went bankrupt, got bought out for pennies, or simply disappeared entirely, long before the survivors ever became durably profitable. Quantum computing has every hallmark of following that exact same historical pattern. And honestly, the financial press covering this sector has started drawing the exact same comparison themselves throughout this year. Every single major transformative technology, over roughly the last 30 years, starting with the original internet, followed by genome decoding, nanotechnology, three-dimensional printing, blockchain technology, and most recently the so-called metaverse, has gone through the exact same predictable cycle. Enormous investor hype arrives years, sometimes even decades, before the actual underlying technology matures into something that reliably generates real profit at scale. Nearly every single one of those hype cycles has eventually ended in a painful, often brutal valuation correction, even while the underlying technology itself, in many cases, went on to genuinely change the world eventually, just on a much longer timeline than early investors were willing to believe. That distinction matters enormously, and it is worth repeating clearly, because it is easy to get confused here. Buffett is not saying quantum computing is fake, or that it will never matter, or that the scientists working on it are wasting their time. He would almost certainly say the exact opposite, that quantum computing could very well become one of the most important technologies of this entire century. What he would push back on, hard, is the idea that today's current stock prices for the pure play quantum computing companies bear any reasonable relationship to the actual provable near-term economic value those specific companies are generating right now. There is another very specific detail from this year's quantum computing story that Buffett would almost certainly zero in on immediately, because it touches directly on something he has talked about constantly throughout his entire career: insider behavior. Over the trailing several years, insiders at IonQ, Rigetti, and D-Wave, meaning the actual executives, founders, and board members who understand these businesses better than literally anyone else on the planet, have been overwhelmingly net sellers of their own company stock. Rigetti has not recorded a single meaningful insider purchase in years. D-Wave's cumulative insider buying over that same stretch has totaled less than $2,000, an almost comically small number for a company valued in the billions. Buffett has said many times that he pays extremely close attention to what a company's own insiders are doing with their own money, because insiders are the one group of people who genuinely understand the true state of the business better than any outside analyst, any journalist, or any retail investor scrolling through social media ever could. When insiders are consistently selling into a rising stock rather than buying, Buffett treats that as an important signal worth taking seriously, not as decisive proof of anything, but as one more data point that tends to align uncomfortably well with everything else the valuation numbers are already screaming. Let's talk about timing too, because it is also worth pausing here to look at how the quantum computing sector actually got this hot in the first place this year, because the specific catalyst tells you a lot about how far removed from pure business fundamentals this entire rally has really been. In May, the United States Department of Commerce announced it would award roughly $2 billion across about 9 different quantum computing companies, and as a condition of that funding, the government took a minority, non-controlling equity stake in each recipient. IBM's Quantum Foundry effort received the largest single award at roughly $1 billion, while smaller players like D-Wave, Rigetti, and a neutral atom company called Inflection each received allocations in the neighborhood of $100 million. The market's reaction to that announcement was genuinely violent in the short term. D-Wave jumped roughly 33% in a single session. Rigetti gained close to 30%. Inflection, a private company at the time, saw its valuation implications ripple outward, and even IonQ, which was not directly part of that specific funding round, still popped about 12% purely on sector-wide enthusiasm. Think about what actually happened there for a moment. None of these companies suddenly discovered a new source of paying customers. None of them suddenly became profitable overnight. A government funding announcement with strings attached in the form of federal equity stakes sent stock prices soaring by double-digit percentages within hours, purely because it validated a broader narrative investors already desperately wanted to believe. Buffett has talked about this exact kind of reaction many times throughout his career, usually with a healthy dose of bemused skepticism. He has pointed out again and again that government funding announcements, no matter how significant they sound in a headline, are not the same thing as a durable competitive moat or a proven, repeatable business model. A one-time cash injection, even a genuinely large one, tells you almost nothing about whether a company can consistently generate profit on its own year after year. Once the initial excitement inevitably fades, and investors start asking harder, more specific questions about actual unit economics instead. There is also a technical dimension to this story worth briefly explaining, because it directly supports Buffett's circle of competence argument in a way that becomes obvious once you actually look at it closely. Right now, there are at least 4 genuinely different competing approaches to building a quantum computer. Trapped ion systems favored by IonQ, quantum annealing used by D-Wave, superconducting circuits used by Rigetti, Google, and IBM, and emerging neutral atom approaches used by companies like Inflection. Nobody in the entire industry, including the physicists who have spent their careers building these machines, currently knows for certain which approach, if any, will ultimately prove scalable enough to deliver reliable, commercially useful results at a competitive cost. That is not a minor technical footnote. It is arguably the single most important fact about this entire sector. And it maps almost perfectly onto exactly the kind of uncertainty Buffett has spent his whole life explicitly avoiding. Investing in a specific pure play, quantum computing company today is not just a bet that quantum computing eventually works. It is a much narrower, much riskier bet that this particular company's specific technical architecture turns out to be the winning one, in an industry where even the leading scientists cannot yet tell you with any real confidence which architecture that will be. Buffett has never been interested in picking the winning horse in a technical race. He cannot independently evaluate, and he has said as much in various forms across nearly every major emerging technology slice of his entire career, from biotech in the 1980s to the internet in the 90s to artificial intelligence more recently. There is a useful, less discussed episode from earlier in Buffett's career that maps onto this quantum computing moment surprisingly well, and it involves the exact opposite lesson from the airline story. In the mid-1990s, well before most investors had ever heard the word internet, Buffett made a very different kind of technology bet, quietly building a large position in the Washington Post company and later in companies with strong, durable information distribution advantages. Businesses he could actually understand and value using traditional cash flow analysis, even though those businesses existed inside industries that were clearly about to be transformed by new technology. He did not need to correctly predict which specific internet company would win in order to benefit from the broader technological shift underway. He simply needed to own businesses with strong existing moats that could adapt and benefit regardless of which specific new technology ultimately came out on top. That is precisely the same logic sitting underneath Berkshire's current stakes in Amazon and Alphabet today. Buffett does not need to correctly guess whether trapped ion, superconducting, or neutral atom architecture eventually wins the quantum computing race. He simply owns two enormous, already dominant businesses that are well positioned to benefit no matter which specific technical approach ultimately succeeds, because both companies have the balance sheet, the talent, acquire, license, or partner their way into whatever specific quantum breakthrough eventually proves commercially viable whenever that breakthrough actually arrives. Buffett has one more deeply held belief that feels almost perfectly designed for this exact moment in the quantum computing story, something Graham originally taught him decades ago. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. In the short run, stock prices move based on excitement, momentum, headlines, and whatever story happens to be capturing the crowd's imagination at any given moment. IonQ, Rigetti, and D-Wave have all posted absolutely explosive gains this year, in some cases surging 30% or more in a single trading session purely off a single piece of government funding news, with essentially nothing about the actual underlying businesses changing overnight. But over the long run, Buffett insists, none of that short-term voting ultimately matters. Eventually, a stock's price gets pulled back down toward whatever the underlying business can actually reliably earn year after year on a sustainable basis. That weighing process can take years to fully play out, sometimes even a decade or more, but Buffett's entire 60-plus year track record is built almost entirely on the patient conviction that it always eventually happens, without fail, no matter how exciting or technologically important the underlying story genuinely is in the meantime. This year has already provided a fairly dramatic real-world preview of exactly what that weighing process can look like when it finally arrives, even in a relatively minor early form. After surging as much as 500% over the trailing year on pure excitement and speculative momentum, the pure play quantum computing stocks experienced a brutal sell-off, falling 60 to 76% below their 52-week highs in a matter of weeks, driven by nothing more dramatic than a broader risk off-rotation across technology markets, and a simple, sobering reminder that these companies still have essentially no meaningful near-term commercial revenue. That kind of violent, sudden reversal is exactly the pattern Buffett has warned about, again and again, throughout his entire career. Whenever a stock's price becomes almost completely disconnected from the actual cash-generating reality of the underlying business. So let's bring this all together and actually imagine concretely what Warren Buffett would say if a reporter shoved a microphone in his face today and asked him directly for his honest opinion on quantum computing stocks. Based on everything we know about his philosophy, his own public statements over the decades, and his consistent, decades-long pattern of behavior around every previous major technology hype cycle, his answer would probably sound something remarkably close to this. Quantum computing might genuinely turn out to be one of the most important technologies of this century. I am not smart enough to tell you whether it will or will not, And frankly, neither is almost anyone else confidently predicting its future today, including plenty of very smart people working directly inside the field. What I do know, with complete certainty, based on 60 plus years of watching markets behave this exact same way over and over again, is that today's stock prices for these specific companies are not being set by careful analysis of proven, reliable cash flow. They are being set by excitement, by momentum, by headlines, and by the very human, very understandable fear of missing out on the next enormous technological revolution. That is not investing. That is speculation. And there is nothing inherently wrong with speculation, as long as you are being completely honest with yourself about which one you are actually doing. That last sentence is genuinely one of the most important things Buffett has ever said on this exact topic, across many different technology cycles throughout his career, and it deserves to be repeated on its own. There is nothing inherently wrong with speculation, as long as you are honest with yourself about which one you are doing. Buffett has never claimed that speculation is evil or stupid, or that people who speculate deserve to lose money. What he has consistently, repeatedly warned against is the far more dangerous mistake of speculating while genuinely believing you are investing, because that particular confusion is exactly what leads ordinary people to bet money they cannot afford to lose on companies they do not actually understand, based on stories that sound thrilling but that nobody can currently prove. If you have made it this far into the video, you are clearly the kind of person who wants the honest, unglamorous version of a story instead of the breathless hype version. And that is exactly the kind of thinking this channel is built around. So go ahead and hit that subscribe button now, because we break down stories like this one every single week, cutting straight through the noise to what the smartest, most patient investors in history would actually say. Now, let's steelman the other side of this argument for a moment, because it would be intellectually dishonest to pretend there is no reasonable counter-argument here at all, and Buffett himself has always been remarkably willing to admit when he got the timing of a major technological shift wrong. He has openly, publicly admitted regret over not investing in Google, now Alphabet, much earlier in its history, famously calling himself an idiot for missing that specific opportunity for years. He also stayed on the sidelines of Amazon for a very long time before eventually buying in, long after the stock had already become an enormous, obviously successful business, meaning he left an enormous amount of potential return on the table simply by waiting for more certainty than the market was willing to offer him. So it is entirely fair to ask whether Buffett's famously cautious, patience-obsessed approach might genuinely cause him, or investors who follow his exact philosophy too rigidly, to miss out on real, generational wealth being created right now inside the quantum computing sector, the exact same way he arguably missed out on a meaningful chunk of Google's early growth, simply because he could not comfortably fit it inside his traditional valuation framework at the time. That is a completely fair, legitimate point, and it deserves genuine respect rather than dismissal. But notice something important buried inside it. Even in the cases where Buffett was demonstrably too cautious and missed real opportunities, he never lost money chasing those opportunities. His mistakes throughout his entire career have almost always been mistakes of omission, missing a good investment rather than mistakes of commission, actively losing significant capital on a bad one. That asymmetry is not an accident. It is the direct philosophy built specifically around capital preservation first and upside second, which is exactly the opposite priority order from how most retail investors currently approach quantum computing stocks in the middle of this hype cycle. There's also a genuinely important middle ground buried in all of this that is worth spelling out clearly, because the whole point of this video is not to tell you quantum computing is fake or worthless. It very well might not be. The middle ground is this. You can absolutely believe quantum computing will eventually matter enormously, while still recognizing that today's specific stock prices for today's specific pure play companies have become almost completely disconnected from anything those companies can currently reliably prove. Those are two entirely separate questions, and Buffett has spent his entire career being relentlessly disciplined about never confusing the two. No matter how exciting, urgent, or historically significant, the underlying technology genuinely appears to be in the moment. If Buffett wanted real, legitimate exposure to quantum computing's long-term potential without betting the farm on unproven speculation, his own personal track record over the past year already shows you exactly what that more disciplined path actually looks like in practice. Buy into large, already profitable, already dominant businesses that happen to be investing serious research money into quantum computing as one small piece of a much larger, already proven, already cash-generating empire, rather than betting directly on tiny, unprofitable, single technology companies whose entire multi-billion-dollar valuation depends almost completely on a series of extremely difficult scientific breakthroughs, all happening roughly on schedule, none of which are guaranteed, and several of which remain genuinely uncertain even among the world's leading physicists. That is precisely the logic behind Berkshire's roughly $7.7 billion combined stake in Amazon and Alphabet. You get real, legitimate exposure to quantum computing's long-term upside, riding quietly alongside two of the most dominant, most reliably profitable businesses on the entire planet, without ever having to bet the actual core thesis of your investment on quantum computing itself working out on any particular timeline. If quantum computing takes off spectacularly over the next 15 years, both companies benefit enormously. If it takes far longer to mature than today's most excited headlines suggest, or even if it stalls out entirely for a decade due to unforeseen scientific roadblocks, both companies still keep printing enormous reliable profits from their existing, already proven core businesses in the meantime, completely unaffected either way. That is, in a single sentence, the entire philosophical difference between how Wall Street's most excited retail traders are currently approaching quantum computing and how history's most successful investor has quietly, deliberately chosen to approach it instead. One approach is a direct, all-or-nothing bet on a specific, unproven outcome happening on a specific, unproven timeline. The other is a patient, diversified, already profitable position that simply happens to include some long-term optionality on a technology that might, or might not, eventually change the world exactly the way today's headlines are currently promising it will. So here is the honest, complete answer to the question this entire video set out to answer. What would Warren Buffett actually say about quantum computing hype? He would almost certainly say the technology itself is genuinely fascinating and quite possibly transformative over the coming decades. He would almost certainly say most of today's pure play quantum computing stocks are trading at valuations that have become completely disconnected from anything those specific businesses can currently reliably prove, resembling speculation dressed up in the confident, urgent language of investing. And he would almost certainly remind you, one more time in that same calm, folksy, unmistakably Nebraska tone he has used for over 60 straight years now, that the single biggest risk in investing has never actually been missing out on the next big thing. It has always, consistently, reliably been permanently losing money you genuinely could not afford to lose, chasing a story that sounded absolutely certain, right up until the exact moment it very obviously was not. If this kind of honest, no hype breakdown of what the market's biggest stories actually mean is something you want more of, make sure you are subscribed. And if this one gave you a genuinely useful new way to think about the quantum computing trade, drop a like too. Because it really does help this channel reach more people who would rather think clearly than chase headlines. Thanks for watching, and I will see you in the next one.